For those with exposure to silver, the current environment requires neither urgency nor denial. It requires intention. What matters this week is not speed, but clarity. The actions taken now, or deliberately not taken, may have consequences that extend well beyond the immediate price movement. Before we proceed, if you find value in structured, non-emotional market analysis, consider subscribing and enabling notifications. These updates are designed to provide continuity during periods when narratives shift quickly. And for context, feel free to note your location and local time in the comments. Understanding the global nature of this audience is always informative. Let us begin with the most important consideration in volatile markets: behavioral control. When silver experiences rapid price movement, the most significant risk faced by investors is not embedded in the asset itself. It arises from the internal response to uncertainty. Abrupt declines trigger instinctive reactions rooted in loss, aversion, and threat perception. Neurologically, the brain processes sharp downside movement as danger rather than data. This response is deeply human, but financially costly. Periods of volatility consistently produce suboptimal outcomes, not because information is lacking, but because decision-making becomes compressed. Time horizons shorten. Long-term positions begin to feel like immediate problems. And actions are taken not because strategy has changed, but because discomfort has increased. Maintaining composure in such conditions is not a passive stance. It is an active risk management decision. Silver is structurally predisposed to volatility because it exists at the intersection of two distinct systems. On one axis, it functions as a monetary metal, responding to real interest rates, currency dynamics, inflation expectations, and shifts in investor sentiment. On the other, it is a critical industrial input, embedded in technology, energy infrastructure, medical applications, and advanced manufacturing. When macro narratives adjust, particularly around liquidity, growth expectations, or monetary policy, silver often reprices faster than gold. This does not indicate a change in its long-term role. It reflects the market's process of recalibrating risk in real time. Understanding this distinction is essential. A sharp decline does not inherently signal a structural breakdown in value. More often, it represents the unwinding of positioning, the liquidation of leverage, or the temporary dominance of short-term capital flows. Historical analysis supports this observation. Some of the most consequential selling decisions are not made at valuation extremes, but during abrupt corrections. Investors who exit positions under stress frequently do so after prices have already adjusted significantly, transferring exposure to participants with longer time horizons and greater tolerance for volatility. Fear alters perception. What was initially established as a strategic allocation suddenly appears as an immediate liability. Markets, however, do not require instantaneous responses. The sense of urgency is psychological, not structural. Remaining calm does not imply ignoring risk. It means recognizing that markets, particularly those involving leverage, routinely overshoot. Forced sellers, whether due to margin requirements, liquidity needs, or risk controls, are not expressing a considered outlook on silver's future. They are responding to constraints. Long-term holders who understand this distinction avoid conflating short-term price pressure with long-term impairment. For investors holding physical silver, emotional selling carries disproportionate cost. Physical metal is generally acquired for purposes extending beyond price speculation, capital preservation, diversification, or protection against systemic instability. Liquidating such positions during volatility often results in unfavorable pricing, widened spreads, and irreversible decisions made under duress. Once physical exposure is reduced, re-establishing it may require higher prices or diminish purchasing power. Optionality is lost. And optionality in uncertain environments is a form of capital. It is also important to contextualize the intensity of market stress. During drawdowns, headlines amplify concern. Social media accelerates narrative contagion. Price charts compress significant movement into narrow visual frames, creating the impression of unprecedented conditions. In reality, volatility is recurrent. What changes is perception. Stepping back, temporally and psychologically, allows investors to reframe volatility as information rather than instruction. Discipline during drawdowns is not obstinacy. It is adherence to a predefined framework. Investors who compound capital over multiple cycles are not those who forecast each inflection accurately. They are those who consistently avoid emotional errors during periods of stress. Once behavioral control is established, the next priority is exposure clarity. Silver is often discussed as a singular asset, but in practice it exists through multiple vehicles, each with distinct characteristics. During stable periods, these distinctions may appear academic. During volatility, they become operationally critical. Physical silver differs fundamentally from paper-based exposure. Coins and bars carry no counterparty risk, but they are less liquid and influenced by premiums, dealer inventories, and regional availability. During sharp price declines, physical markets often behave differently from futures markets, with supply tightening and spreads adjusting. Treating physical silver as a short-term trading instrument misaligns with its intended function. It behaves more like balance sheet insurance than a tactical position. Exchange-traded silver products introduce financial structure. They provide liquidity and ease of access, but they are governed by fund mechanics, trading flows, and market sentiment. During periods of stress, these vehicles may experience amplified volatility driven by short-term capital rather than physical supply dynamics. Mining equities represent leveraged exposure, but not pure price leverage. They are operating businesses with cost structures, management decisions, capital requirements, and geopolitical exposure. When silver prices decline, miners often underperform due to margin compression and risk repricing. When prices rise, they can outperform significantly. Failing to distinguish between metal exposure and equity exposure frequently leads to misaligned decisions. Leverage further complicates the landscape. Futures, options, and margin-based instruments impose structural timelines and capital requirements. During sharp market moves, these instruments can force liquidation irrespective of conviction. Understanding whether any portion of silver exposure includes leverage is essential, as it determines the degree of control retained during volatility. Exposure assessment is not merely an inventory exercise, it is an alignment exercise. Capital preservation, tactical allocation, and speculation require different instruments. Problems arise when intent and structure diverge. Volatility exposes such mismatches rapidly. With exposure clarified, structure becomes the stabilizing mechanism. In the absence of predefined decision levels, investors are left reacting to price movement in real time. This often results in emotionally driven actions. Establishing tactical ranges and protective thresholds introduces discipline. These levels are not forecasts, they are contingency plans. They transfer decision-making from moments of stress to moments of clarity. Different exposures warrant different parameters. For some positions, thresholds define risk containment. For others, they signal improving long-term value. The precise level is less important than the rationale supporting it. Protective limits are not admissions of error. They are tools designed to prevent small setbacks from becoming structural damage. Flexibility remains important. Tactical ranges should evolve as macro conditions change. Adjustments should be methodical, not reactive. Using ranges rather than precise points reflects market reality. Markets rarely reverse at exact levels. Ranges allow engagement without demanding false precision. Periods of sharp decline often appear as environments to avoid. Historically, they are often environments to assess. Aggressive selling in silver rarely reflects a sudden loss of relevance. More commonly, it reflects tightening liquidity, speculative unwinds, or forced de-risking. Viewing price weakness as contextual information rather than existential threat reframes opportunity. This does not imply attempting to identify a bottom. Markets can overshoot. Structure, not timing, is what matters. Gradual accumulation, when aligned with portfolio balance and liquidity, acknowledges uncertainty while improving long-term entry conditions. Silver's structural demand profile remains tied to both monetary dynamics and industrial application. Sentiment shifts quickly. Industrial demand evolves incrementally. During downturns, pessimism often dominates discourse because it aligns with recent price action. Yet markets tend to punish crowded positioning. Incremental engagement during periods of broad pessimism has historically favored patient capital. Any decision to increase exposure should be proportional and intentional. It should not be driven by loss recovery or emotional reinforcement. Liquidity underpins all such decisions. Discretionary capital preserves flexibility. The capacity to wait is itself a strategic advantage. Beyond silver, macro forces exert influence. Monetary policy expectations affect non-yielding assets. Currency strength amplifies or suppresses price movement. Geopolitical developments alter risk sentiment. Industrial indicators provide grounding context. The objective is not prediction, but awareness. Finally, portfolio resilience depends on balance and liquidity. Volatility increases correlation. Concentration risk becomes more pronounced. Liquidity preserves autonomy. Balance prevents unintended outcomes. Silver remains among the most volatile and emotionally charged assets. Rapid declines feel threatening. Strong rallies feel persuasive. This period is not about emotion. It is about execution. Maintain discipline, preserve flexibility, respect structure. Volatility is transient, process endures.